All right. Thank you for joining me. We are just getting started. Thank you very much. Hello, I'm Mitch Goldberg. You're watching my live stream. Be the boss of your money. We talk about the stock market a lot. We talk about the economy. Sometimes I educate you about this to give you the tools you need, the information, knowledge, enlightenment that you need so you do nothing. Because I think most of the time, for your everyday saver and investor, you don't need to do anything. Let all this bad news pass, oil, war, and and the stock market will get back to its winning ways because that's what it's always done. Yes, I know past performance is no guarantee of future performance, but that's why we're in the market because over time, we expect the stock market to go up. We expect companies to create more value. So we expect the shares of these companies to be worth more. And that's what this is all about. So sometimes it's best to do nothing. We've got a lot to talk about. So we have a lot to talk about today. So that is not nothing. Um, a real lot to talk about. There's so much going on, and every day the stock market's up, the stock market's down. Sometimes it's up and down a lot, a big trading range in the middle of the day. And well, a lot of people are going to be making a lot of decisions. They're not going to be good decisions, most likely, because we have this fight or flight instinct where we have to do something, okay, either run away or fight. When it's best often for investors to do nothing. It's kind of weird, but this is going to sound strange to you, but the best traders are often also very similar, I guess, to the best golfers I know. People who are just kind of lacking in emotion, unfazed by things, uh, and are also the people that they're just not bothered by things. Are you like that? Most people are not like that. I am personally detached from market moves, not because I don't have emotions. I'm definitely an emotional person. Look, I love, I feel strongly about things. So listen, don't go, oh, bitch is emotional. Oh, he shouldn't be trading or investing or doing personal finance. Don't give me that. I'm emotional because I feel love for people, because I care, because I have empathy. Okay, let's get that straight. But what I'm saying is, when it comes to the market, I've been doing this, what I do now, for over 30 years. So if the market's up or down, and this, big ups and downs is something that could possibly phase me, really dig into my soul, I would not have lasted that long in my business. I'm pretty calm. Like, I don't get crazy. The market's down or up. Even during the 2007, 2008, 2009 financial crisis, never got that down about it. I never hid under my desk. I just went about my day and still had good times. Trust me, there are bigger things in life than the economy and the market. I have life experience. I know these things. Um, so but that's how I do it. And that's why, I've always noticed clients who have more experience, older clients, they're not really phased by the ups and downs of the market. Now, don't get me wrong. There are I meet people all the time who are my age and older. In fact, I just spoke to a friend the other night who is a little bit older than I am. So I'm 55. My friend I recently met with is 59. And she said that, can't believe how much money she's losing, but she was doing so well. And she thought she was really doing great. Look, it's been a bull market for the last, 12, 13 years. So everybody did well, but people actually thought they did well because they were really good with money. So they spent maybe more money than they should. They lived a higher lifestyle than they should have, because they had a wealth effect. The stock market is up. So the stock market has created more wealth. It's given people the ability to spend more, or at least the false sense of security of spending more. By the way, you see my screen is glitchy right now. It's driving me freaking crazy. Today, the cable companies here, I upped my internet download speed to a full a gigabyte per second. It's the highest speed you can get. Um, the reason it's still glitchy is because I now need a new router to handle that speed. So I just ordered one. It could take a couple of days. I can't just go to like Best Buy and buy a router. It's got to be a specific kind of router. I have a static IP address, so that's once the router comes in, it's got to be programmed. It's not just like pulling a piece of equipment out and replacing it with another piece of equipment. And I always use like high quality routers with really good security systems built in. Okay, so we've got a couple of things to talk about. It yesterday the title of the live stream was same shit different day, and I think that goes on. So we're going to talk about this. My friend Dave, I don't know if you're watching, Dave DiPietro asked me a question yesterday, and I'm going to answer that question. I'm going to actually put it up here, and we're going to go over what to expect to inflation. Kathy Woods, we're going to talk about the ARC ETF, Germany, the dollar. There's all you hear about now is a strong dollar. It's a huge thing, and the inverted yield curve. So there are two things that are really kicking the snot out of the economy and the stock market right now. So I have a comment already. I see your comment out there. Thank you. Elliot is out there, but let me just run a quick intro, then I'm going to get into all this good stuff. Here we go with the intro. All right, welcome back. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. We're just getting started. We talk about personal finance, investing, the stock market, interest rates, inflation, etc. We talk about oil, all commodities really, borrowing, planning for college, you name it. We talk about it here. Hey, if you like what you see, give us a thumbs up, maybe a heart, an applause, celebrate, depending on what reactions are available to you, depending on which social media platform you're watching on right now. We stream to a whole bunch of them, including YouTube, LinkedIn, Facebook, and Twitter. We post a lot on Instagram as well. I don't do live streaming on Instagram because I would basically have to keep my phone open and just stream to that, but then you wouldn't be able to see the rest of my screen. It really wouldn't work well. It's kind of I'm hoping Facebook changes their mind about letting us use Instagram for live streaming, but we'll see about that. If you have any questions, words of wisdom, words of encouragement, that's what the comments are for. I love hearing from you. It's the best part of what we do. So let's just talk what's going on real quick. We have three things going on right now in the world. Corporate earnings are kicking off. They started today with Procter and Gamble. Decent numbers, but we've got a slew of earnings, and it's going to take about 4 weeks to get through the earnings season. And the earnings season that's being reported is up till June 30th. So right now it's July 12th. But up to June 30th, we're going to see what companies, CEOs, CFOs have to say about inflation, about how they're getting through the economy, how supply constraints are affecting them. And we're going to find that there are fewer and fewer companies that are able to make the right moves to get through these economic storms intact. So you're seeing it's really difficult to be a single stock investor, but it also sucks right now being an index investor too, because things are just generally going down. But that is the sign of a bear market, when investments just generally, stocks generally go down. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. You probably have that memorized because I say that every single day. All right, so we have earnings, and we're going to see what they look like, and then we have inflation figures for the last month, for the month of June. They're coming out tomorrow. Yes, I know tomorrow is July 13th, but typically the month's inflation figures are released in the middle of the following month. So we see the inflation figures for June. It's expected to be in the high 8 range, 8.8% or so. The previous month was 8.6%. We could see a 9% print. We could see a lot of different, anything could happen. But whatever it is, we've been talking about this. We are getting, in my opinion, to the end of the inflation rise. We're now getting ready for inflation to moderate. Not to say that inflation is going to roll over, but it's going to go up much less incrementally. Eventually, it'll roll over, but we're going to have to let a few more months go by, because then the old inflation numbers roll off, and then we get the new inflation numbers. But we've been going over this last couple of days. Uh, Base metals, copper, right, are all down on the year. Lumber is down on the year. Um, oil, oil is still up about 20% in the year, but it's down a ton in the last few weeks, and it's below 100 on it's below 100 on West Texas Intermediate. We're going to go over this in a minute. All of a sudden, commodities are going down and going down fast, and that's a sign that the world economy is slowing down. That we are, I think, at least the U.S. economy, I believe, is in a recession. Forget Europe. Europe, I think, is getting just absolutely smashed right now. I mean, do you know in Germany, the price of electricity in Germany is up by 600%. Could you imagine taking your electric bill and multiply it by 6? That would be your electric bill. Your home heating oil bill would probably go up a number of multiples also. What would you do if that was to happen? You wouldn't be able to spend any money on anything else. You'd actually, some people, a lot of people, have to decide food, fuel, or medicine. It's a really ugly situation what's happening, and it's killing the economic engine of Europe, which is the German economy. All right, so another tailwind or another headwind in the economy. The title today is "Tailwinds and Headwinds: Stocks Stuck in the Middle," and stocks really are. So, but anyway, I do think for inflation, for the United States, inflation has peaked. It's going to start to come down. It already is coming down. Prices of the raw commodities that are used to build everything are coming down. It's just going to take a little while to feed into the rest of the food chain. Like stuff that just hit the shelves now are not going to go down in price. It's the stuff that's going to hit the shelves in like 2 or 3 months. That stuff will be at a lower price. So it's just going to take a little while. Maybe it'll help a little bit for the back to school shopping season. Probably it'll help even more for the holiday shopping season, which is right around the corner. I know I don't want to be depressing to you, like talk about the holiday shopping season when we're like right in the middle of summer. But you know how it is. It's already the middle of July. It's flying by. Sorry, I'm hanging on to summer as hard as I can, as tightly as I can. Um, hey, don't forget to give us a thumbs up or a like or a happy face or something, and ask me questions in the comments or something like that. Okay, I'm giving you the big picture stuff. So it's inflation. It's the dollar. We have to think about the dollar. We talked about earnings, inflation, and the dollar. So I'm going to show you something, okay? I'm going to put this screen up. I'm going to get rid of the icons. Okay. You're hearing a lot about the strength of the U.S. dollar. The U.S. dollar and the euro are at parity. The U.S. dollar is surging against other major currencies like the yen. And is this what I'm looking at? You see $108.17. Okay. This is the DXY, the Dixie, the US dollar currency index. It's basically a basket of currencies that are compared to the US dollar. And when the US dollar goes up against a basket of currencies versus other currencies, this goes up. This index goes up. I'm not saying that a dollar is worth 108. It's $108 for a unit of a basket of currency. I'm just saying the index is 108. Let's not even call it dollars. It's 108.17. It says here, this yellow bar, 52-week high today. It's been saying 52-week high like every day for a while now. The dollar is getting really is very strong, and there's a number of reasons for that. First of all, investors are worried about a recession globally. So where do you want to keep your money? You want to keep your money in the US dollar denominated assets like US treasuries, which is why interest rates have started to go down a few weeks ago. Not up, down. Long term yields have been going down. Not you keep hearing about short-term rates going up, like the Fed's raising short-term rates, the Federal Reserve, but long rates have been going down while short rates have been going up. That creates a yield curve inversion. We're going to get into that in a second. But what happens is when there's a strong dollar, it makes our exports more expensive to foreigners. So it hurts our exports. Okay. And what it does is it affects the trade balance, okay, the trade deficit, and that lowers GDP. Okay, so when it lowers GDP, it contributes to a slower economy, and it may be contributing to a recession fears. We're going to find out Friday when the GDP numbers for the second quarter come out if we truly are in a technical recession. And I know what you're saying. Well, labor is good. The employment figures have been so strong. The employment figures are the last piece of the puzzle to roll over. Labor figures like the non-farm payroll that came out this past Friday, that's a lagging indicator. Let's see where that is in 6 months. But I don't want to get into that right now. I'm just giving you the reasons why I think we're in a recession, and I'm giving you some of the big concerns, big picture concerns. I want you to know that I know what's going on, and you can come to me when you need to know what's going on. Now, I've got a comment out here from Elliot, who is a professional trader, and oh no, I'm sorry, Elliot. Sorry, Elliot. I'm thinking of a different Elliot, but thank you. I see Elliot Huddle. Will the Fed be successful in bringing inflation down to 2%? If so, any idea what interest rates could get up to? I mean, that is like the capital THE, the question of the day. That question right there, Elliot, is everything. It's hard to imagine the Fed just raising rates a couple of times and getting inflation from almost 9% down to 2%. But I kind of agree with this. It's weird. Kathy Woods. Let me just put up a screen here. And Kathy Woods is not somebody that I ever agree with. I don't know her personally. I don't have any skin in this game. I don't own shares of the ARK fund. It's to me, the ARK fund is just it's a concentrated fund. It's not my kind. It's not my cup of tea. Okay, but Kathy Woods says deflationary forces could pressure the Fed to make a policy reversal. I agree with that, and she's been outspoken about that. That deflation or hard to come by inflation could be coming back. I know it's hard to imagine with the highest inflation that we've had in over 40 years. Okay. 40 years ago, I was 12 years old. So, wow. 15 years old. I'm not giving myself enough years on my life. I was 15. Okay. 14, 15 years old. And that was high inflation. So I was in like 9th grade, 10th grade with sky high inflation. And, didn't really seem like it was the biggest thing in the world at the time. But then again, I was just a kid in high school and my mind was on other things. And I'm sure I do recall my parents were very concerned about inflation and the economy at that time, which is like one of the reasons why I became a financial advisor, by the way. All right. So I don't know if the Fed will be successful. I know that's not the answer we want to hear. I should know. You're the professional. I don't think the Fed has to be successful though in bringing inflation down. I think it's already happening because global supply constraints are loosening up, and it's something that's worth repeating. I've said it before, but it's not. I didn't make this up. I've heard this, and I repeat it. The cure for high prices is high prices. When prices go up, be it a commodity like oil or corn or cars, eventually manufacturers produce more or mine more, raise supply, and then supply catches up to demand, and prices either find an equilibrium or they go down. Usually we overproduce to overcompensate for demand, and then prices go down. And then when prices go down, the cure for lower prices is lower prices. Manufacturers go out of business, miners go out of business, or they pull back, they cut back production to get supply in line with demand, and then demand either, and then prices either stop going down or start going up again. And that's why we have these boom bust cycles in the economy, which the Federal Reserve is desperately trying to stop, unsuccessfully, by the way. Okay. I'm not saying that there's not a place for the Federal Reserve. That's like a whole other topic. All right. So I hope that helps you. But I think inflation, I don't think the Fed has to raise rates anymore to get inflation down because it's already happening. The Fed's going to raise rates, and then they could go into a policy reversal where they have to maybe take back some of these rate increases and start to cut rates again, or at least just stop raising rates and give it a rest for a little bit to evaluate their next move. So that's that. Okay. So we went over the Dixie. Okay. I just want to put this up here. I showed you this headline, right? And I showed you the dollar index at a 52-week high. Let's take a look at the yield curve. Let's go over here. Okay. Let me pop myself up here. This is the bond market, treasuries. Short-term rates were up ever so slightly, barely a move. And long-term rates were down ever so slightly. But the 10-year, which is over here, which is 2.974, is lower than the 305. Okay, so it's about 8 basis points. So let's take a look at this. And it says 8 basis points. Okay. See this negative? This negative should be positive. When this is negative, this is the US 2-year, 10-year spread, which is 0.08. Okay. See this big number, 0.08. This is, and you could track this on a number of websites. I track it on CNBC. It hit a 52-week low, so it's going lower. It means that it's a signal of low confidence in the U.S. economy. It's a signal that we are heading into a recession. Now, there's still time for this negative 0.08 to go positive, but the longer it's negative, the worse it is. And it tells you that banks which borrow short term and then long term don't want to do that because they'll lose money. And it slows down credit growth in the U.S. economy, which is a negative for the economy. All right. So we went over that. We went over the yield curve. The yield curve is pretty negative right now. And let me find okay, here it is. So that's the yield curve. So you look at the 2-year and the 10-year. All right. And that should be the other way around. In fact, the 1-year is almost equivalent to the 10-year. And that just really shouldn't be. The 1-year yield should be lower than the 10-year yield. It's kind of like buying a CD at the bank. If you buy a 6-month CD, you get a low yield. But if you buy a 5-year CD, you get a higher yield. Now imagine if you could buy a 6-month CD with a higher yield and the 5-year CD with a lower yield. You're not going to buy the 5-year CD. You can just put all your money into the 6-month yield. And that's more or less what's happening with treasuries right now. It's not really a good thing for the economy. I had a question yesterday from a good friend of mine, David DiPietro. Go follow him on LinkedIn. Friend of mine, and he asked me a question in my live stream, and I don't know if he asked me the question before or after the live stream, but I missed it. So this is what David asked me from my live stream yesterday. Okay, I'll just give it a little highlight. Well, let me highlight it. Okay, so anyway, if we do go into a brief recession, that is the GDP number coming out Friday is negative for first, I don't know, for the first 2 quarters, but goes positive in the second 2, 3. I don't know. Let's just say positive in the quarter after that. Will the market make a low before then, in your opinion? Okay, so my opinion is that by the time it's acknowledged that the U.S. economy is actually in a recession, the stock market typically starts to work on self-repair and starts to go up. There are enough stocks that have been absolutely obliterated for me to confidently stand on my soapbox and shout to the world the excess valuations in the stock market, in my opinion, have been wrung out. You look at the meme stocks, SPACs, crypto. I mean, you're talking about, and you look at the big tech stocks. Even I mean, valuations have been just crushed. Stocks are down so much. I think the valuations have been wrung out. The overvaluations have been wrung out. And I do think that if we are actually technically in a recession, I think that we're probably already getting ready to work on repair, and the market has probably put its bottom in. Hope that answers your question, David. I hope you're watching today. All right. Let's take a look at the major averages. We didn't do that yet. It's usually something we do first, but Dow off 200. It was up about almost 200 earlier today. It was down at one point, down 300. It was actually negative. The futures were negative this morning, but then everything turned around when the market opened. NASDAQ was down another 1% after being off over 2% yesterday. So NASDAQ has been getting pummeled so far this week. It's only Tuesday. S&P 500 down almost 1% again. Gold continues to break down. Can I tell you something about gold? I've been saying for so long that there's a disconnect with gold. The reason I keep looking in that direction is because there's a timer, and I've been doing this now for 26 and a half minutes. And I want to make sure I stop at 30 minutes. We could go on, but it is what it is. Okay. So gold, there's something wrong with gold. Like I feel like gold is just broken. Why is, if we have sticky inflation, gold should be soaring, but gold never really moved with all this inflation. And gold basically told you that the inflation we're seeing is not permanent. It's COVID, it's supply constraints, it's the way the world went from manufacturing and buying goods to services, etc. So that is that. In fact, hold on. Buckley. Hey, what's up, Dan? Dan Buckley says gold is overrated. That's right. Gold is overrated. Hasn't worked as a hedge against inflation. It's kind of at a 2-year low, and it seems to be breaking down a little bit more every day. Thank you very much, Dan, for stopping by. All right, so and let's keep going. Let's get back to that because I want to look at oil. All right, oil. Holy smokes! It's not even more than I thought. Last I looked at oil was 99. It's down to 95. 95 the barrel for West Texas Intermediate. It was like 125, 130 recently. Down over 8% today. Oil typically could fluctuate 0.5% to 1%. That's not out of the ordinary. But going down over 8%, okay, down over 8%, that is a pretty big deal. The VIX was up a little bit, up 20 to 27. Just an indication of a little more fear coming into the market. News out, Twitter sues Elon Musk to enforce its original merger agreement. That's a freaking soap opera, means nothing to me, so I'm not even going to get into that. I don't know why it gets that. I don't know why that Twitter story gets so much coverage. It's not even that exciting to me. By the way, thank you, Dan, and thank you, Jay, for joining us. Jay, you've been so good, man. We've got to catch up. I missed the Mayfest in the city, I know, but just couldn't make it that night. Just couldn't do it. Last thing I want to show you is the ARK Fund. Okay, people talk about the ARK Fund like maybe now it's a good buy, and I saw one analyst said that the ARK Fund, ARKK, could be like a really good mover now. Like, this is an analyst opinion about the ARK Fund. This is the Kathy Woods ARKK innovation exchange traded fund, and it's just gotten crushed, like down 70-80% from its high. And I did an expose on it. By the way, Buckley, try as much as I can, brother. Thank you, brother. Thank you. But I just want to show you this to show you what's in the fund, because of this. People who were looking at the ARK Fund to buy as like a way to make up for lost time or to trade the down stocks, the DoorDashes of the world, the Zooms, the Pelotons, all these stocks are crushed. So maybe they'll go back up and you could just buy it in one neat and tidy package like the ARK ETF, which is known to be in those kinds of companies. Here's the thing. Looking from the expose I did at the end of last year to now, there are only 5 of the same stocks are in it. All right. It's not the same fund that it was back then. Tesla was the biggest position in the fund. Tesla's gotten crushed, by the way. Zoom was in the fund, but now Zoom is the biggest position. I'll just show you what I'm looking at. This is from ETF.com. Okay, maybe I could make this a little bigger so you can see it on your smartphone. All right. Where'd it go? Okay, so Zoom. Forget these little bubbles here just because the page is trying to refresh. But Zoom, Roku, these were in it. Tesla's still in it. But CRISPR, UiPath, we're not in it. Exact Sciences, we're not. Intella and Block, we're not in it the last time. Twilio was in it. It's not the same fund that it was a year ago. I don't know if this is the way to play things. Maybe the fund manager, Kathy Wood, should have just left the same stocks that she's always had in it instead of trying to go into different stocks, but still more or less correlated and in the same, speculative or very aggressive growthy areas. Is that fair to say? So I don't think ARK is the it's not the same fund that it was. So if you're looking to buy something that's down a lot, well, that thing you're looking to buy is not the same thing today as it was back then. So I hope that makes sense. I'll just give you a quick little snapshot of what I said before we go. Okay, here we go. So let's talk about the ARK fund. Michael Burry. He is well regarded for sounding the alarm on subprime mortgages right before the Great Recession and made a tremendous amount of money from being early to the blow up and shorting the bond market, shorting everything, and he made billions. Now he is shorting Kathy Wood's ARK Innovation ETF. This is the famous ETF, ARKK. The stocks in the fund, I think, are worth noting: Tesla, Teladoc, Roku, Coinbase, Zoom, Square, Unity, Shopify, Twilio, and Spotify. Now it's got Palantir. It's a more concentrated fund. As a result, it's subject more to the ups and downs of a smaller amount of positions. If you're looking for a fund that is truly all about innovation, then that's what this is for. This is not about saying, well, the NASDAQ is up 15% year to date, for example, and this fund is down year to date. Get rid of it. It's not a good fund. That is not what this fund is for. And if you're buying it for that, I think you're making a mistake and you're probably not getting into it for the right reasons. The key with ARK Innovation Fund is if you want a fund. All right, I'm not going to make you watch the whole thing, but the fund was about $116, $117 then. And today, the fund is $44. Okay, that is a massive drop. Okay, it's like an $11, $12 stock going down to 40, going down to 4. Okay, it's not the same stock. So careful is all I'm saying. Is if you're looking to buy something down a lot as a way to buy the beaten up innovation, technology / pandemic stocks, you really have to make sure that you know what you're getting. And that's why I always say you have to know your fund. You have to look under the hood and compare. And there might be a better way to go about it. That's all I'm saying. Okay, so we're definitely going overtime here at 34 minutes. Thank you so much for joining me. I'm taking off tomorrow from the live stream. I have a Zoom for my clients to go over some of my good points about my new affiliation with a company called Sierra Ridge Wealth Management. Don't worry, I'm still client for strategy, but they're going to handle my back office operations, and I'm very excited about it. And I will see you tomorrow. Hi, Tina. Nice to see you. I'll see you guys on Thursday. Thank you very much.